The usual rules apply. I'll let you know when the quizzes are graded. You can come pick them up at the usual spot. So sooner rather than later. So today we're going to start on real options, and we're going to kind of lay the foundations, because to use real options, you need to understand what an option is. Okay. What an option is, and at least the basics of option pricing. I'm going to ask you a question. I'd like an honest answer. Have you seen option pricing models in your foundations class? Like, what did you see? Black-Scholes, binomial. So I'm going to assume you remember nothing. And I'm going to go back to basics and kind of lead you to what exactly an option pricing model tries to do. So let's start by looking at what a real option is. If I gave you cash flows in a discount rate and you took the present value of the cash flows, you get a value today. That's how we thought about valuation and intrinsic valuation. But here's what you might be missing when you take the present value of the expected cash flows and come up with the present value today. There could be things you might be able to do that are not built in the cash flows. Let me give you an example. In capital budgeting, if the present value of the cash flows is less than the initial investment, the net present value is negative, right? So what are you told to do? Don't take the project. But what if I gave you the rights to this project for the next 10 years? You're saying, why would I want the rights to a negative net present value project? Why might you pay for the rights to negative net present value project? Because things can change, right? I could give you an AI technology that's not viable today, but you'd be crazy to throw it away saying it's not viable today. You might pay for it. That's called the option to delay. The second is, if you're a company that is that's setting up a factory, there's capacity in it, you can adjust the capacity. In good years, you can produce more. In bad years, you can produce less. We're going to talk about oil companies. Oil companies have reserves. They get oil out of the reserves, but the amount of oil they get will be a function of the oil price. Higher oil price, you produce more, you adjust your production. That's an option. Sometimes you might take an investment in a country or a market that's a big market, but the initial investment you're taking has a negative net present value. Let's take AI again, or China 20 years ago. You're entering the market, your initial investment, the project you're looking at is negative net present value. But you know why you might still take it? Because taking that project might give you a chance to get into that big market. It's a word strategic that people use. I'm going to talk about the optionality that you might take a bad project because it gives you the right, that's your option to expand. And finally, when you take a long-term project, what worries you? You take a project, you project out the cash flows, it looks good, but you're worried that 3 or 4 years into the project might not be that good, right? Wouldn't it be nice if you could walk away from that project? It's called the option to abandon. You can actually structure your life around options to delay, options to expand, option to abandon. So essentially, you can see them play out. Here's the reason real options excite people. McKinsey has an entire team for real options. Some of the bankers have real options team, because what a real option argument allows you to do is take your discounted cash flow valuation and add a premium on top of it. So remember, you came up with the DCF value for your company. Many of you came up with a value lower than the stock price, but you really, really wanted to buy the company. I'm giving you an escape hatch saying maybe there's an option here. So today we're going to ask some tough questions about options. But before we do that, I'm going to set up a very simple decision tree to illustrate where the optionality comes from. Where does that premium come from? So this is a tree where you have a 50% chance of success, and you're going to make 100 million, and a 50% chance of failure, and you're going to lose 120 million. Would you take this investment? What's the expected value, Andrew? It's -10. Everybody get that? 50%. Now I'm going to take this investment and I'm going to break it up into two smaller parts. So first investment, you got a 75% chance of succeeding. And if you do, you make plus 20. There's a 25% chance of losing, in which case you lose minus 20. If you make the plus 20, you continue. And in the second round, there's a 2/3 chance that you'll make another 80 and a 1/3 chance you lose 100. If you look at the cumulative upside here, 20 plus 80 is 100, cumulative downside, 100, it's 1 minus 120. You work out the probabilities, it's 50-50, but here's the magic. The expected value of this tree is positive. So I want you to give me an intuitive explanation as to why when I take that one decision tree and break it up into a small tree first and a bigger tree, where is that additional value coming from? What am I getting to do? Yes. You observe that first step. Think of it like a test market, right? You tie the test. If the test market works, what do? You continue. If it doesn't, you just stop. Real option arguments are built on two components. One is learning, that you learn as you go along. And the second is adaptive behavior. You change the way you behave. A little later in the next class, we're going to talk about why oil reserves are real options. Why? Because oil companies observe the oil price. And then they can change how they behave based on observing the oil price. So anytime you see a real option, you're going to see those two things under the surface. But it's easy to get carried away with real options. It's easy to overcome it. So you can say my DCF value is $10 below my price, but there are real options here. So I want to give you 3 questions I want you to ask anytime somebody makes a real options argument. Could be a consultant, could be a banker. First, make sure there is an option. I have a paper on my website called Opportunities Are Not Options. People often talk about big markets as options. That's enough. First, so I'm going to show you what you're looking for something to be an option. Second, make sure that option has significant economic value. Otherwise, why waste your time finessing that option? And I'm going to give you the key word there that you need to check to see if an option has significant economic value. And third, if you actually want to apply an option pricing model to value the option, see if it meets the requirements for an option pricing model. Is there an option? Does the option have significant economic value? Can I use an option pricing model? So as I said, I'm going to assume nothing. I'm going to go back to basics. And let's first start by looking at what makes an option an option. Nick, what does an option give you? What do you get with an option? Let's say replace word ability. You get the right to buy in a call option at a fixed price, or the right to sell at a fixed price. Keyword is right. Why does it matter? You're not required to. You will do it only if it's in your best interest. So when you think about an option, the first thing to remember is options are leeches. They derive their value from something else. They can't live on their own. So when you talk of an option, first there has to be an underlying asset. So whenever you say there's an option, I'm going to say, what's your underlying asset? And that's something you're going to see me try with real options is whenever I talk about an option, I'm going to talk about the underlying asset. The second feature of an option is there some kind of contingent payoff. In the case of a call option, if the stock price rises above the strike price, you make money, but if it stays, so that's a contingent payoff. In fact, the best way to recognize when you have an option is by drawing a payoff diagram. Look at what your cash flows will be at different prices. And here's what options will look like. There will be limited downside because it's a right. You don't have to enforce it. So if the stock price is less than the strike price, you lose what you paid for the option. But if the stock price rises, dollar for dollar, you can make potentially unlimited profits. If you have a put option, flip the whole thing on its side. If the stock price is above the strike price, you lose what you paid for the put. If the stock price is less, it's not quite unlimited because your stock price can't go below 0, but you make very large profits. But the key is you have limited downside, unlimited upside. I'm going to come back because that's going to be significant and why options are different from any other asset. So that's the first stop. Draw the payoff diagram for whatever you're describing as a real option. If it looks like this, I don't care what it's called. We're going to argue there's an option and we're going to try to value it. So that's the first stop. Make sure there's an option, that you're not looking at something that's not an option. Second stop, you want to make sure that the option you're looking at has significant economic value. So I'm going to throw the word in that I think is absolutely necessary when you talk about options. Do you have exclusivity? What does that mean? You and only you can exercise this option. I'll give you an example. Let's suppose, did you rent an apartment, Nick? Let's suppose I'm your landlord and I give you the right to buy your apartment a year from now. Do you have an option? What did I not tell you? At what price, right? The right to buy an apartment is not an option because anybody has the right to walk in and buy the apartment at the prevailing market price. If I give you the right to buy an apartment at 300,000 or 500,000, there's an option. Why? Because you and only you can exercise at that price. The right to buy at the prevailing market price is not an option. So let's take, when you think about exclusivity, we're going to look at a continuum. We're going to talk about patents as options. Where does the exclusivity come from when you own a patent? As long as the government enforces. Remember, patents are only as valuable as the government enforcement mechanism that makes sure that you and only you. So there the exclusivity comes from the government enforcing that you're the only one who can. An exclusive license, obviously you have exclusivity. But rather than think of 0-1, where you have no exclusivity and complete exclusivity, you can think about a continuum. The stronger your competitive advantages, the more towards exclusivity you are, the weaker your competitive advantages. So we're going to talk about with real options, where in that continuum do you fall? No exclusivity or complete. And the more complete your exclusivity, the greater the value of the option. So is there an option? Does that option have significant economic value? Now let's talk about what drives the value of an option. Unlike valuing a stock or business where you wave our hands and talk about all these variables, we know exactly what drives the value of an option because it's a derivative asset. There are only 6 variables that determine the value of the option. So you guys are going to be call options. You guys are going to be put options. You can be the observers and tell me whether they're getting it right. I'm going to go item by item, and I want you to tell me as that item changes how your option will. So call options, put options, you get the right to buy at a fixed price, the right to sell at a fixed price. Let's pick a company, Tesla. So you have call options in Tesla, you put options in Tesla. Tomorrow evening is Tesla's earnings report. Everybody's waiting on bated breath because all kinds of bad news has come out about the company. Let's say the earnings report comes out and the stock price pops by $30. It goes up. What happens to the value of call options on the stock? It increases because you got the right to buy at a fixed price. So if you got the right to buy at 170 and the stock price pops up, call options will become more valuable, put options will become less valuable. Everybody agree? Okay, so that's the first variable. Second is the variance in the value of Tesla. And here's where options are different from any other asset. The more variable, so right now we don't know what tomorrow evening will bring. In fact, tomorrow is going to be an extraordinarily volatile day for Tesla. Up or down. You know what's going to happen to the value of call options because of the volatility? Increase. What about the value of put options? Also increases because you're both because we don't know which direction volatility is going to kick in. So variance goes up, both call and put options become more valuable. Because risk, to use one side, you don't have no downside risk. The third variable, and this is a tricky one, and this is not going to be the case for Tesla, but let's say you have a call and a put option on Con Ed. Con Ed pays dividends. You're saying, so what? You know what happens when a stock pays dividends on the ex-dividend date to the stock price? Let's say Con Ed is going to pay a $2 dividend tomorrow. What can you expect the stock price to do tomorrow? It's going to go down by $2. And here's why. If it did not go down by $2, you know what we'd all do? We'd buy the stock today, collect the $2, sell at the end of tomorrow, and keep the $2. Markets are not that easy. So on the ex-dividend day, the price is going to drop. So let's get back. Let's say you have a call option on Con Ed, you have a put option on Con Ed. Tomorrow is going to be an ex-dividend day. What do dividends do to call options? Decrease the value or increase the value? Decrease, because when the dividend pay gets paid out, the stock price will drop. So call options are worse off, put options are better off. So the value of the asset, the variance in the value, the expected dividends. There are two variables that come from the option itself. First, I said with the call option, you get the right to buy at a fixed price, right? So as that exercise price, which is what the fixed price is called, this, or the strike price, goes up, what happens to the value of a call option? It should decrease. The right to buy at $180 is worth less than the right to buy at $160. But with put options, the reverse is going to be true because you get the right to sell. The higher the price, the more valuable put options become. So that's the strike price. And then there's the life of the option. Let's say I have 3 months left in the option, I extend it to 6 months. What happens to the value of call options when I give you more time to play the game? It should go up, right? You get 6 months instead of 3 months. And what happens to put options when I give you more time? It should also go up because you get more time. Because in both cases, you have a right. The longer I give you the right for, the greater the chance you will get a chance to use it. So notice two variables work in the same direction. Variance and time work in the same direction for call and put options. Every other variable is going to cut in opposite directions. There's one and only one macro variable that affects options. You get the right to buy a stock at a fixed price. When? In 3 months or 6 months or a year. Do you see why interest rates are going to come into play? The higher interest rates become, the lower the present value of what you have to pay. So if you have a call option, the right to buy something at 150 a year from now, as interest rates go up, the present value of what you have to pay goes down. Call options will become more valuable because you don't have to pay for a year. What will happen to put options? They'll get less valuable because you're going to collect the cash flows in a year and the present value of those cash flows will now be lower. That's it. Those are the 6 variables. I want you to remember them because now we're going to enter this rarefied air of option pricing. First, let's go back in time. The 1960s, options were first, you had warrants and people were trying to value. Paul Samuelson, Nobel Prize winner, wrote one of the first books in economics, came up with an option pricing model. And he valued like any other asset. He took the probabilities, the expected cash flows, a risk-adjusted discount rate, and he came up with the value of the option. And for a long time, that was the standard. You valued options like every other asset. And then in the early 70s, 1971, Fisher, Black, and Myron Schultz essentially came back with an argument of why are we trying to value the option like any other asset? An option derives its value from an underlying asset. What if we could create something that looks exactly like the option? You see, what does that even mean? An option is cash flows, right? If I could create something that looks exactly like the option in terms of delivering the same cash flows, it's called a replicating portfolio, you essentially have 2 things that will deliver the same cash flows. So the first argument for option pricing is replication. And the second is the 2 have the same cash flows, they have to sell at the same price. Replication plus arbitrage is at the heart of every option pricing model. I know it sounds abstract, but I'm going to take you through what's called the binomial model because you're going to see replication arbitrage play out in real time. And then I'll show you how you make the leap from the binomial to the Black-Scholes, which is what you often end up using in practice. Okay? So here's the replication argument. And this is what Fisher, Black, and Myron Schultz saw, which gave them the Nobel Prize. They looked at a call option and said, look, I can create something that looks exactly like the call option in terms of cash flows by borrowing money and buying the underlying stock. Let me repeat that again. You can replicate a call option by borrowing money and buying the underlying stock. You're saying, how much should I borrow? How many shares should I buy? That's what the option pricing model is going to give you the answer to. If you have a put option, you can replicate a put option by selling short the underlying asset and taking the money you get when you sell short and lending it out at the risk-free rate. Every option can be replicated by the underlying asset and either borrowing money if it's a call option or lending money if it's a put option. So all option pricing models are about finding out what that replicating portfolio looks like. So I'm going to start with what's called the binomial model. The binomial model is an incredibly impractical model if you're trying to actually value an option, but it's a good place to start to see how replication arbitrage play out. A binomial model, a stock can jump to only 1 of 2 points. So it's very limiting. So let's suppose you have a stock that's trading at 50, it can either go to 70 or it can go to 35. If it goes to 70, in the next stage, it can go to 100 or 50. If it goes to 35, it can jump to 50 or 25. So at t equal to 2, the second time period, this stock can be at one of three prices, 100, 50, or 25. I give you a call option on this stock with a strike price of 40, which expires at t equal to 2. So you ready? I've given you the right to buy the stock at $40. It expires at t equal to 2. Let's work at every price what your cash flows are going to be if you own the call option. So let's say the stock goes to 100. What do you get? You get the right to buy at 40, right? Will you exercise the right? I hope you do well, because you can buy it at 40. You will buy the shares at 40, sell it at 100, and you will make the $60 difference. If stock goes to 50, you'll exercise again at 40, sell at 50, make 10. If the stock goes to 25, what do? It's a right, not an obligation. So you say, I wish I hadn't done that. You throw the option in the trash can, but your cash flow is going to be zero because you're not exercising the option. So those are the cash flows in the call. So here's my objective. I want to create a replicating portfolio that has exactly the same cash flows as the call. And I'm going to do it by borrowing money and buying shares in the underlying stock. When you replicate an option, you always start at the expiration date of the option. Do you know why? Because that's the only time you know what the cash flows are, right? The middle you don't, and you work backwards. So let's start with a stock price at 70, and you're trying to figure out how much to borrow and how many shares of stock to buy. So let's say you borrow B dollars. Hang in there with me, it's completely abstract. And you buy delta shares of stock. You're saying, what the heck is B and D? And as I said, we'll get there. If you borrow B dollars and buy delta shares of stock, and the stock goes to 100, your position is going to be worth 100 times delta, your shares at 100, minus the borrowing repaid with interest. So let's assume the interest rate is 11%. The 1.11 times B is the borrowing paid off. So the stock goes to 100, 100 times delta minus 1.11B is the value of your replicating position. And remember, the cash flow value is 60. So that position's got to be worth $60. If the stock goes to 50, 50 times delta, because you still own the same number of shares, minus the borrowing with interest, has to be equal to 10. I know it's been a really, really long time since you saw simultaneous equations, but remember them? Like a distant memory. What was it, 7th grade, 8th grade? But if you have two equations and two unknowns, and you work long enough and hard enough, there should be no unknowns. And I solve for the simultaneous equation. It turns out that if I solve, I get B equal to $36.04 and D equal to 1. You see, what the heck does that tell me? If I go out and borrow $36.04 and buy one share of stock, I've created a position that has exactly the same cash flows as the call if the stock goes to 100 or 60. I have replicated my call option. And how much did it cost me to create this replicating position? Well, I buy one share of stock, that'll cost me $70. But because I'm borrowing $36.04, that difference, $33.96, becomes the value of my replicating position. And here comes the arbitrage argument. If that replicating position has the same cash flows as the option, guess what? The option has to have a value of $33.96. I've now valued the option at the stock price of 70. You see where I'm going to go next, right? I go to the stock price of 35. What's my objective again? I want to borrow B dollars and buy delta shares of stock. So if the stock goes to 50, my cash flows are 10. The stock goes to 25, my cash flow is 0. 50 times delta minus borrowing with interest is 10. 25 times delta minus borrowing with interest is 0. I solve for D and B. $9.01 for B. I know you 0.4 shares. I don't even know how you do it, but let's say you can. If you borrow $9.01 and buy 0.4 shares of stock, you've created a position that has exactly the same cash flows as the call. It'll cost you $4.99. I value the call. The stock price goes to 35. So now I have the values of the call. The stock goes to 70, 33.96. Stock goes to 35. Guess what I'm going to do? I'm now going to go back to T equal to 0. And I do exactly the same thing. 70 times D minus the borrowing with interest has to be equal to 33.96. 35 times D minus the borrowing with interest has to be equal to 499. And again, I solve, I get B equal to 2161 and D equal to 0.8278. If I go out today and I borrow $21.61 and buy 0.8278 shares of stock, I have created a position that's going to look exactly like the call at every step in this tree. Same cash flows. And because it's exactly the same cash flows, what it cost me to create this position, $19.42, will be the value of the call option. But it's a very limiting view of the world, right? Because at any point in time, your stock can jump to only 1 of 2 points. Let's take a stock like Tesla. I don't know what the start of the day price was, $155. If I asked you, what will the price be at the end of the day? You're not going to come up with 2 numbers. You're going to come up with 2,000 different numbers, right? The world is a messy place. So if I wanted to try this on a 3-month option, the only chance, and even there, I might be stretching it, is if I made the time really short, right? 1 second intervals. So let's suppose you are one of those very patient people and you decide to take a 3-month option and break it into 1 second binomial. You have a really sharp pencil and a really big sheet of paper. And you start drawing little. Yeah. And you broke. How many seconds are there in 3 months? I'm not expecting an answer, but a lot of seconds, right? So when you're done, what will your page look like? Really crunched up, tiny little branches that you've done thousands and thousands and thousands of branches. You ready? You've done that. You made time really short. You now flip the paper on its side. So basically, the binomial tree goes like this. You flipped it. It looks like a Christmas tree without a trunk, right? Now smooth out the outside edges of the tree. You take a Christmas tree, you smooth out the outside edges. What does it start to look like? A normal distribution. The binomial distribution converges on the normal distribution. If as t gets smaller, price changes also get smaller. It's called a continuous price distribution. The Black-Scholes model is a limiting case of the binomial if prices move continuously. What does it mean when prices move continuously? In a continuous price world, here's how you get from $30 to $50. You go 30, 30.01, 30.02, 30.03, 30. There's no jumps. You go gradually. It's a little impractical, right? Can Tesla jump in the next minute? Yeah, it can go from 30 to 50 or 50 to 30, depending on what Elon Musk does in the next minute. In the real world, there are jumps, but the Black-Scholes was derived for a world where prices don't jump, they move. And it has consequences. Do you know when you use the Black-Scholes model to value deep out of the money options? You know what deep out of the money options are, right? So we talked about call options, you get the right to buy. Let's suppose you have a call option with the right to buy Tesla at $180 and the option expires tomorrow. In the Black-Scholes world, that option would be worth nothing. You know why? Because the stock's at 155 now. Think of how much work it'll be to get from 155 to 180 in a continuous price world. But in the world we live in, that option is going to be worth a lot more because prices can jump. Black-Scholes models consistently undervalue deep out of the money options because the assumption it makes about continuous price distributions. Now, one of the biggest mistakes in investing often is taking the Black-Scholes and forgetting the continuous price assumption you're making there. Because I've seen people devise products based on the Black-Scholes which blow up because they forgot that assumption. I'll give you an example. In the 1980s, I started my teaching at UC Berkeley. And at that time, at the office next to mine sat the head of the department, Mark Rubenstein, and he and another person teaching at Berkeley started a company called Leland O'Brien Rubenstein. And here's what they sold. You're a portfolio manager. By the time you got to 1987, you had a great bull market. The $10 million you invested in 1981 was now worth $80 million. And you were worried. Worried about what? That the price would drop. So I come to you with a product and you tell me whether you might find this product attractive. I come with a product where I guarantee you that your portfolio will never drop below 75 million. That sounds pretty amazing, right? But think in option terms, what have I just sold you? A put option. You're saying, how did you come up with a put on my very specific portfolio? They use that replicating portfolio from the Black-Scholes to create what's called a synthetic put. A synthetic put is a put you create. So they ran the Black-Scholes, they came with the delta and the bid, and they put it into the model. And they sold. So you feel pretty good as a portfolio manager, right? You bought insurance against the downside and you go back to sleep. Nothing to worry about. And it worked really well until you got to October 19th of 1987. Remember what happened that day? I told you the very first day of class. What happened on October 19th of 1987? The S&P dropped by 22% in one day. So you're a portfolio manager. You feel pretty good. You bought insurance against exactly this happening. At the end of the day, you get a call from Leland O'Brien Rubenstein. And here's what they say. That insurance you bought, it didn't work today. Saying, this is exactly the day I bought it for. You see why it broke down? They created the replicating portfolio using Black-Scholes, which assumes continuous price changes. In the Black-Scholes word, prices never drop by 22% one day. It takes a month or a month and a half. You gradually adjust. But there was no chance to do a gradual adjustment because prices jumped. So as time gets shorter, if price changes get smaller, the binomial model becomes a Black-Scholes model. So let's talk about Black-Scholes, because this is a rite of passage that you go to business school for. Let's see how much intuitive understanding we can put on the Black-Scholes. So 1971, Fisher Black and Myron Scholes come up with this idea of a replicating portfolio. And they decide they're going to solve for that replicating portfolio. So they write out the equation, and they have to get a first derivative of the equation. And they discovered that they need mathematics that nobody in finance had ever seen before. It's called stochastic calculus. Nobody in finance had ever done that. So rumor has it that the equation sat on Fisher Black's desk for weeks because they couldn't come up with that first derivative. Then this unnamed physics PhD student was walking through the finance department at the University of Chicago, went into the office. Don't ask me why. He was probably trying to steal something. And he looked at the equation on the desk and he said, hey, we see this in physics all the time. There's this mathematical concoction called Ito's lemma that you use to get the first derivative. And rumor has it that he wrote the first derivative out, which means that when they gave the Nobel Prize, they should have given to Fisher Black, Myron Scholes, and the unknown student who came up with that equation. So I'm going to show you what the Black-Scholes model is composed of. And as I list out the ingredients that go into Black-Scholes, I want you to tell me what's missing. So the original Black-Scholes, they get this PhD student, give the final piece, they come up with a model. And in the original Black-Scholes, there were 5 inputs that determine the value of a call option. There's the value of the underlying stock, S, the strike price, K, the life of the option, T, the risk-free rate, R, and don't ask me why, but Microsoft Office, when I go from Mac to PC, turns all my sigmas into question marks. So it's not question mark squared. It's sigma squared, the variance, 5 variables. But just a few minutes ago, I listed out 6 variables that determine the value of an option, right? What's a missing variable? What do you not see there? Time is there. Life to expiration of the option. Yes. Dividends were missing. You know why? Because they had trouble solving the equation with dividends. So you know what economists do when they have trouble? They assumed it away. The original Black-Scholes was designed to value what were called dividend-protected options. What's a dividend-protected option? Remember what I said happens to your stock price when I pay a dividend? Your stock price drops by $2. In a dividend-protected option, the strike price is also knocked down $2. How many dividend-protected options are in the world? 0. But they had to get something easy to do, and they came up with the original Black-Scholes. Again, remember, the question mark becomes sigma. So this is the original Black-Scholes, and it'll force you to use all those virgin buttons on your calculator, those buttons you've never touched before, the natural log, the exponential. But let's list out what the ingredients are. You start with the current stock price, S, and you multiply by N of D1. You're saying, what the heck is N of D1? Well, I can't go there till I tell you what D1 is. D1 is a function of S, K, R, T, and sigma, all those things that drive the value of the option. That's what the physics Ito's lemma gave them, is that equation for D1. And D2 is just D1 minus sigma times. So it's basically D1 and D2 come from those 5 variables. So you compute D1 and D2, you're going to come up with numbers. N of D1 and N of D2 are just areas under a normal distribution that you get with the D1 and D2. So let's say you get a D1 of 2.00. N of D1 then will be 0.9772. If you got a D1 of minus 0.50, N of D1 will be 0.3085. Notice in this table, the lowest number N of D can take is 0. The highest number is 1. Looks a lot like a probability, right? Because probability values can go from 0 to 1. I know that option pricing purists will kill me for doing this, but N of D1 and N of D2 are rough estimates of probabilities. In fact, N of D2 has a very specific meaning in option pricing. It's the risk neutral probability that S will be greater than K, that your option will end up in the money. So when you compute an N of D2 of 0.83, you're saying there's an 83% chance this option will be in the money. If N of D2 is only 0.33, there's a 33% chance your option will be in the money. So you compute D1 and D2, you go to that table, you get N of D1 and N of D2. They say, what the heck is KE minus RT? K is the strike price. The original Black-Scholes was designed to value what are called European options. It's an unfortunate turn of phrase because it suggests it's something to do with geography. There's nothing to do with geography. Somebody tell me the difference between European options and American options? Yeah. Anytime up. So let's continue with that. So let's say I have 2 options. The European option I can exercise only at the end of the 3rd month. The American option I can exercise any time over the next 3 months, assuming they have exactly the same characteristic, K, T, R. Which one should be worth more? Tell me why. Because you get everything that the European option gets, plus the right to early exercise, right? Something you cannot do. The original Black-Scholes was designed to value European options, again, because it made the math easier. Most of the options we're going to run into are American options. When we use a Black-Scholes model, we're getting a lower bound on the value because these options have early exercise rights. We'll come back and deal with that when we talk about real options. So you come up with, but embedded in the Black-Scholes is the replicating portfolio. Remember when we did the binomial? We solved for delta and B be the amount you borrowed. The Black-Scholes actually has the replicating portfolio. N of D1 is called the option delta. It's a number of shares of the underlying stock you would buy to replicate the call. KE minus RT, which is E minus RT is just a present value factor. I've told people if you don't have the exponential button in your calculator, just use the present value. Why present value? Because remember, in a European option, you don't have to pay the strike price till the option expires. I'm taking the present value of the strike price. So KE minus RT times N of D2 is how much I borrow. I borrow this, I buy N of D1 shares of stock, I've essentially replicated the call option. So what you saw in tangible terms in the binomial is hidden in the Black-Scholes, but it's in there. One of the biggest problems people have with the Black-Scholes, they plug the numbers in, they get a value for the option, they move on. But the real value of the Black-Scholes is looking at the N of D1 and the present value, the KE minus RT N of D2, because it tells you how to replicate it. If you ever run into option traders, they created their own language to keep the rest of us out. And the Greeks are really pissed off about what they've done. Because everything in option trading is a Greek alphabet. So option delta is the number of shares of stock you'll have to buy to replicate the call option. As the stock price changes, will the option delta change? Yeah, absolutely. That's called the option gamma. As the life of the option goes from 3 months to 2 months and 29 days, will the delta change? Absolutely. That's called the option theta. As the standard deviation of the stock price goes up and down, will the delta change? It's called the option vega. I told you they stole every single Greek alphabet you can think of, but everything they're talking about is in terms of that replicating portfolio. You've cracked the code now on option pricing. Don't let them throw vegas and thetas at you. They're really talking about how will the replicating portfolio change as these variables change. So I'm going to leave you with one final page because the original Black-Scholes had no dividends. And that's a problem. Because even on the CBOE, the Chicago Board of Options, once options got listed, a lot of the stocks in which options got listed had dividends. So traders had to figure out a way to adapt or adjust the Black-Scholes for dividends. And the adjustment is actually very simple. You go out and you buy a stock. You know, in the original Black-Scholes, you borrowed money and bought a stock. So the interest rate you paid on your debt was the cost of maintaining the position. But let's say your stock pays a dividend. You see what you're going to do, right? You're going to take the dividend, cover some or much of the cost. So in the D1 and D2, you'll now see a dividend yield. So if you're paying a 5% interest rate and you have a 2% dividend yield, it's only the 3% you got to come up with. It's called a carrying cost. So that's the first adjustment. Second, remember what I said happens to your stock price when you pay a dividend? It tends to drop. I adjust the current stock price for the expectation that over the next year, I'm going to pay a 2% dividend yield that will cause my stock price to drop by roughly 2%. It looks like a present value factor, but I'm adjusting the stock price for the expected drop from the dividend yield. You make those adjustments, you got a dividend adjusted version of the Black-Scholes. The next session, when we start, we're going to talk about real options. Many of those real options are built around expected something, like a dividend yield. So I'm going to start off with why in a real option dividend yields enter the picture, even though you might not call them dividends. But we're going to actually use what we've talked about today, the foundation, to look at patents, look at natural resource options, so essentially a whole host of options. So that's on Wednesday's agenda. So I will see you then. Yeah. Yep.
So I was looking at my DC after this,
Yeah.
and I have a negative interest expense.
You can't use an interest
So I
coverage ratio.
couldn't do the,
But really negative. Interest rate is always negative.
well, looking through capital options, they're giving you, they're overpaying on their interest expense.
No, it might be a net interest income. Interest income exceeds interest expense.
So,
Just use zero. Yeah. It's not, companies are not the options, right? So there must be something specific to the company. So in the case of an oil company, I'm going to look at oil reserves as an option. The underlying asset is the oil under the ground. And the optionality comes from the fact that as oil prices go up and down, the value of that oil goes up and down. So essentially I'm going to take some component of the company and make it an option. The company itself can't be an option. In the case of Facebook, the option might be the platform. The optionality comes from the fact that right now the platform is used only for advertising, but if they can ever figure out a way to sell stuff or do something else on the platform, that's an option. So it's some aspect of the company that will become the option.
So like basically, determine when
Basically, what you're trying to do is when you did the original DCF and you value Facebook as an advertising company, because that's the only viable thing they can do, you're ignoring the fact that they have 3 billion people, 57 minutes every day on that platform. And that should be worth something because there's other stuff they might be able to do. So it's optionality allows you to capture that. I don't know what else they can do, but I think they can do other stuff, right? The thing that you can. So this actually starts putting a number on, will that be a big number, an average number, or a small number? So even if we don't attach a number to it, it'll give us a way of thinking about what kinds of companies that real optionality will be high. So the exclusivity is going to come into play. If you have something that 100 other people have, I'm not going to give you a platform and optionality. No, but if you have a platform which is exclusive, and Facebook does, and a lot of people spend a lot of time on it, then I'm going to say there's an option there, and it's going to add on to my DCF value of Facebook.
Okay. Thank you. I'll probably follow up with some more questions by email.
Okay.
Balancing losses.
Okay.
Thank you.
do you ever